Hello, and what's going on, everyone? We're going to be looking at the Bitcoin white paper today. So let's take a look into Bitcoin, a peer-to-peer electronic cash system. Introduction. Commerce on the internet has come to rely almost exclusively on financial institutions serving as trusted third parties to process electronic payments. While the system works well enough for most transactions, it still suffers from the inherent weakness of the trust-based model. Completely non-reversible transactions are not really possible, since financial institutions cannot avoid mediating disputes. The cost of mediation increases transaction costs, limiting the minimum practical transaction size and cutting off the possibility for small, casual transactions. And there is a lot broader cost in the loss of ability to make non-reversible payments for non-reversible services. With the possibility of reversal, the need for trust spreads. Merchants must be wary of their customers, hassling them for more information than they would otherwise need. A certain percentage of fraud is accepted as unavoidable. These costs and payment uncertainties can be avoided in person by using physical currency, but no mechanism exists to make payments over a communications channel without a trusted party. Now, who is this trusted party that they're speaking of? Well, it's going to be our brokers and our banks that we use as intermediaries that, find the buyers and connect the sellers. It basically takes them out of the situation, making them irrelevant. So that is the introduction behind Bitcoin and the inherent purpose behind it. What is needed is an electronic payment system based on cryptographic proof instead of trust, allowing any two willing parties to transact directly with each other without the need for a trusted third party. Transactions that are computationally impractical to reverse would protect sellers from fraud, and routine escrow mechanisms could easily be implemented to protect buyers. In this paper, we propose a solution to the double spending problem using a peer-to-peer distributed timestamp server to generate computational proof of the chronological order of transactions. The system is secure as long as honest nodes collectively control more CPU power than any cooperating group of attacker nodes. So, transactions. They define an electronic coin as a chain of digital signatures. Each owner transfers the coin to the next by digitally signing a hash of the previous transaction and the public key of the next owner and adding these to the end of the coin. A payee can verify the signatures to verify the chain of ownership. So here you have a transaction chain. You have transaction owner 1's public key, go to the hash, go to owner 0's signature, and then also will be verified in transaction owner number 2 by verifying the signature from owner 1's public key to owner 1's signature. Now the problem, of course, is the payee can't verify that one of the owners did not double spend the coin. A common solution is to introduce a trusted central authority, or mint, that checks every transaction for double spending. After each transaction, the coin must be returned to the mint to issue a new coin, and only coins issued directly from the mint are trusted not to be double spent. The problem with this solution is that the fate of the entire money system depends on the company running the mint, with every transaction having to go through them, just like a bank. We need a way for the payee to know that the previous owners did not sign any earlier transactions. For our purposes, the earliest transaction is the one that counts, so we don't care about later attempts to double spend. The only way to confirm the absence of a transaction is to be aware of all transactions. In the mint-based model, the mint was aware of all transactions and decided which arrived first. To accomplish this without a trusted party, transactions must be publicly announced. And we need a system for participants to agree on a single history of the order in which they were received. The payee needs proof that at the time of each transaction, the majority of nodes agreed it was the first received. Now, the solution is the timestamp server. The solution we propose begins with a timestamp server. A timestamp server works by taking a hash of a block of items to be timestamped and widely publishing the hash, such as in a newspaper or Usenet post. The timestamp proves that the data must have existed at the time, obviously, in order to get into the hash. Each timestamp includes the previous timestamp in its hash, forming a chain with each additional timestamp reinforcing the ones before it. And this is how we get the term blockchain. Proof of work. To implement a distributed timestamp server on a peer-to-peer basis, we will need to use a proof-of-work system similar to Adam Black's Hashcash, rather than a newspaper or Usenet posts. The proof-of-work involves scanning for a value that, when hashed, such as with SHA-256, the hash begins with a number of 0 bits. The average work required is exponential in the number of 0 bits required and can be verified by executing a single hash. For our timestamp network, we implement the proof of work by incrementing a nonce in the block until a value is found that gives the block's hash the required 0 bits. Once the CPU effort has been expended to make it satisfy the proof of work, the block cannot be changed without redoing the work. As later blocks are chained after it, the work to change the block would include redoing all the blocks after it. The proof of work also solves the problem of determining representation in majority decision making. If the majority were based on one IP address, one vote, it could be subverted by anyone able to allocate many IPs. Proof of work is essentially one CPU, one vote. The majority decision is represented by the longest chain, which has the greatest proof of work effort invested in it. If a majority of CPU power is controlled by honest nodes, the honest chain will grow the redo the proof of work of the block and all blocks after it, and then catch up with and surpass the work of the honest nodes. We will show later that the probability of a slower attacker catching up diminishes exponentially as subsequent blocks are added. To compensate for increasing hardware speed and varying interest in running nodes over time, the proof of work difficulty is determined by a moving average targeting an average number of blocks per hour. If they're generated too fast, the difficulty increases. Network. The steps to run the network are as follows. 1. New transactions are broadcast to all nodes. 2. Each node collects new transactions onto a block. 3. Each node works on finding a difficult proof of work for its block. Number 4. When a node finds a proof of work, it broadcasts the block to all nodes. 5. Nodes accept the block only if all transactions in it are valid and not already spent. 6. Nodes express their acceptance of the block by working on creating the next block in the chain using the hash of accepted block as the previous hash. Nodes always consider the longest chain to be the correct one and will keep working on extending it. If two nodes broadcast different versions of the next block simultaneously, some nodes may receive one or the other first. In that case, they work on the first one they received, but save the other branch in case it becomes longer. The tie will be broken when the next proof of work is found and one branch becomes longer. The nodes that were working on the other branch will then switch to the longer one. Incentive. By convention, the first transaction in a block is a special transaction that starts a new coin owned by the creator of the block. This adds an incentive for nodes to support the network and provides a way to initially distribute coins into circulation, since there is no central authority to issue them. The steady addition of constant amount of new coins is analogous to gold miners, expending resources to add gold to circulation. In our case, it is CPU time and electricity that is expended. The incentive can also be funded with transaction fees. If the output value of a transaction is less than its input value, the difference is a transaction fee that is added to the incentive value of the block containing the transaction. Once a predetermined number of coins have entered circulation, the incentive can transition entirely to transaction fees and be completely inflation-free. The incentive may help encourage nodes to stay honest. If a greedy attacker is able to assemble more CPU power than all the honest nodes, he would have to choose between using it to defraud people by stealing back his payments or using it to generate new coins. He ought to find it more profitable to play by the rules, such rules that favor him with more new coins than everyone else combined, than to undermine the system and the validity of his own wealth. Privacy. The traditional banking model achieves a level of privacy by limiting access to information to the parties involved and the trusted third party. The necessity to announce all transactions publicly precludes this method, but privacy can still be maintained by breaking the flow of information in another place, by keeping public keys anonymous. The public can see that someone is sending an amount to someone else, but without information linking the transaction to anyone. This is similar to the level of information released by stock exchanges, where the time and size of individual trades, or the tape, is made public, but without telling who the parties were. An additional firewall, a new key pair, should be used for each transaction to keep them from being linked to a common owner. Some linking is still unavoidable with multi-input transactions, which necessarily reveal that their inputs were owned by the same owner. The risk is that if the owner of a key is revealed, linking could reveal other transactions that belonged to the same owner. In conclusion, I'll go ahead and read it from here since I didn't put it on the slide. We have proposed a system for electronic transactions without relying on trust. We started with the usual framework of coins made from digital signatures, which provides strong control of ownership but is incomplete without a way to prevent double spending. To solve this, we proposed a peer-to-peer network using proof of work to record a public history of transactions that quickly becomes computationally impractical for an attacker to change it if honest nodes control a majority of CPU power. The network is robust in its unstructured simplicity. Nodes work all at once with little coordination. They do not need to be identified since messages are not routed to any particular place and only need to be delivered on a best effort basis. Nodes can leave and rejoin the network at will, accepting the proof of work chain as proof of what happened while they were gone. They vote with their CPU power, expressing their acceptance of valid blocks by working on extending them and rejecting invalid blocks by refusing to work on them. Any needed rules and incentives can be enforced with this consensus mechanism. And I will link all these references below in the description so you can take a look at what this is all about. Have a good one. That was Bitcoin white paper.